Nigerian market coming under pressure on Friday, and the banking sector one of the key losers on the bourse on Friday. We had Skybank shedding almost 5%. Now, those results rather disappointing there. The bank hopes to achieve a 20% increase in loans over this year. Is this something that you think is achievable given the fact that they only achieved 1.6% increase in loans and advances during the first quarter?
Yes, Samantha, I think it's achievable. In Q1, the bank's gross earnings increased by about 3.4%, and we always had the view that the first half of the year will be quite slow. And I think also it's good to point out that Skybank sold some loans to AMCON, some bad loans to AMCON, so that was also responsible for the lower increase in the first quarter of the year. But I believe that the bank will be able to grow its loans and advances by a higher figure because now the balance sheet is much cleaner. The NPLs are falling down to about 6.8% from 12% at the end of last year. So I think it's actually on a stronger footing right now. And also, if you look at the top line, it reduced just slightly by 1.6% compared to its peers like Access Bank that had a 12% decline in the top line, and there was a strong increase in the bottom line in PDP and PAT and PBT. PBT increased by about 33%, but I think the only point I would say gives me some concern was an increase in its cost-to-income ratio. Cost-to-income ratio increased about 71% from 67% where it ended last year. But I think as long as we see a stronger loan growth going forward, the bank will be able to achieve at least a 65% cost-to-income ratio. But so far, I would say that the results have been in line with expectation. Valuations are still quite attractive. It's trading at book value right now, while the sector average also is at book value. Its P estimate for 2011 is at 6 times earnings, while our coverage average is about 8 times. So it's at a discount, and also based on our target price, it's currently trading at 41, at a discount of 41%. So I think there's still room for appreciation for investors, and also I think the bank's overall performance has been strong so far.
Let's take a look at your Tier 1 sector report. You indicating that you've downgraded the stock UBA, yet all the other banks you are positive on, you're bullish on for 2011. Can you just very briefly give us an indication of what themes you saw coming out of the full year report for 2010 and which banks you've got your eye on for 2011?
I think for 2010, performance overall for the Tier 1 banks, I would say was broadly in line, but for UBA, where we saw strong disappointing results, the loan loss expenses was about 18 billion, while as at Q3 was only at about 5 billion. So I think the 12 extra billion that was made in the fourth quarter was a point of concern. And also, if you look at cost-to-income ratio across the Tier 1 names, it's currently at an average of 65%, while UBA's cost-to-income ratio is at about 71%. So I think that's also concerning. And also loan growth as well. There was a declining for UBA. The trend was declining from beginning of the year till the end of the year, while for other banks like GT Bank, Zenith Bank, we saw stronger loan growth, but for UBA, there was a declining trend. And in terms of ROEs, GT Bank came out strongest at 18%, while UBA was quite weak at less than 1%. So I think overall we like GT Bank, we like Zenith Bank and First Bank. I think First Bank, the fact that the bank has decided not to go ahead with the M&A with Oceanic Bank reiterates our strong view on the bank. And I think with us, we feel that the bank will be able to improve its operational efficiency without merging with any bank at this point.